Welcome to the Credit Compass, your guide to navigating the European credit markets. We break down the biggest moves in credit, uncover the macro trends reshaping the landscape, and explore fixed income strategies for Europe and the UK. Today, we're diving into two new UK trade deals, one with India, the other with the United States. Neither is completely final just yet, but they mark a meaningful shift in the UK's post-Brexit trade landscape. We will also cover plans for European negotiations, including the impact of the pharma pricing changes announced by the US administration. And further, there were some interesting elements to the Bank of England interest rate voting that highlight some uncertainty on the part of central bankers in the current climate. Let's get into it. It's been nearly a decade since the Brexit vote, and one of the central promises of the pro-Brexit campaign was the freedom to forge independent trade deals tailored to the UK's interests. Now, after years of negotiations, the UK has announced two major trade agreements in a single week. Well, sort of. The deal with India is close to being a finalized free trade agreement, while the one with the US is more of a framework than a finished product. Still, both are signs of progress. It's worth remembering that forging trade deals as a standalone nation was a central promise of Brexit. But these negotiations take time, years in fact. While some may take credit for the end result, they have been in discussion for years and require patience, compromise, and political will on both sides. The India and US deals aren't perfect, but they mark a turning point and signal that post-Brexit Britain may finally be settling into its new trade identity. So, what's in them? Let's start with the UK-India trade deal. This deal has been years in the making and offers real substance. It includes tariff cuts on iconic British exports like whiskey, gin, biscuits, and salmon. India will reduce tariffs on UK whiskey from 150% down to 75% immediately, with further cuts planned over the next decade. Similarly, duties on UK-made cars, currently above 100%, will drop to just 10% over 10 years. Other key UK sectors like aerospace, consumer goods, and professional services also stand to benefit. Tariff reductions will happen on aerospace parts and engineering goods. Some consumer goods like cosmetics, biscuits, and salmon will benefit from reduced tariffs. Further, services will benefit with the expectation for increased cross-border activity, although notably the Indian financial services sector remains protected. So what does India get out of the agreement? Well, traditional Indian exports like textiles and garments will not have any tariffs, alongside Indian leather goods and footwear, as well as trade in jewelry and precious stones. Further, a number of food products, including rice and processed foods, will also be able to be sold in the UK tariff-free. On the services front, the UK and India will mutually recognize certain qualifications and support the ease of business travel between the countries, supporting professional services. Overall, the UK government estimates a GDP boost of nearly $5 billion by 2040. That's about 0.2% of current GDP. Not exactly earth-shattering, but in a stagnating economy, even marginal gains matter. And for targeted industries, this could be a tailwind. It also opens a door for growth in trade with a growing nation. Now to the US deal, which, to be clear, isn't a full free trade agreement. It's more of a framework to rebuild trust and momentum after years of stalled negotiations. The headline wins: tariffs on steel and aluminum will drop from 25% to zero, but only if the exporting company isn't Chinese-owned. UK car exports also get a break, with tariffs falling from 27.5% to 10%. However, agricultural goods and food standards remain sticking points. The UK has been reluctant to relax its regulatory standards, and that's holding up a more comprehensive agreement. Interestingly, Deutsche Bank analysts estimate that this deal may slightly reduce UK GDP compared to the beginning of the year conditions, although it's less damaging than earlier projections. Even if the numbers don't move GDP much today, politically this deal helps solidify the UK's relationship with Washington, a crucial strategic anchor as global alliances shift. That relationship could become even more vital amid the US-China trade rivalry. The Bank of England also made headlines last week with a rate cut. That wasn't a surprise, but the vote was split three ways. 2 members wanted a larger cut, 2 wanted no cut at all, and the rest went with a modest quarter-point move. The key concern here? Wage growth. At 5.5%, it's still elevated, and that keeps inflation expectations sticky. Our view is that rates will continue to trend downward, but perhaps more slowly than markets may expect. Watch the labor market data closely. Persistent wage growth could keep the Bank of England cautious. Lower rates provide a tailwind for credit issuance. We're already seeing stronger demand in primary markets, and companies are moving quickly to lock in lower funding costs. The quality of credit matters more in this current environment, especially for issuers tied to trade-sensitive sectors. This also means more scrutiny from investors. Looking across the channel, the US is now turning its trade focus to the EU. The tone is more confrontational, as both sides are preparing their positions. The EU is hard to negotiate with, by design, but it's not sitting still. It's already floated targeted tariffs in response to US threats. Together, the US and EU represent nearly a third of global trade, especially in high-value sectors like pharmaceuticals, aerospace, and finance. Services are the hidden giant here, especially in tech, insurance, and digital infrastructure. When it comes to negotiations, timing matters. Both sides are under pressure to secure supply chains. They are both keen to align on digital standards, albeit from strongly different positions, and at least from an EU perspective, respond to the climate challenge. A broad free trade deal is unlikely, but narrower agreements, similar to the UK around things like steel, autos, pharma, tech, and data, are in play. Let's hope that they can, at a minimum, achieve something similar to the UK-US deal, something below the baseline 10% in aggregate. And, of course, they're working against a deadline now, a little over a month left before the current 90-day extension expires. One sector in these negotiations to watch closely is pharmaceuticals, especially from an Irish perspective and given the announcement earlier this week from the US. Ireland is deeply intertwined with US pharma. In 2023, nearly 28% of Irish goods exports went to the US, totaling about $54 billion. Crucially, pharmaceuticals and chemical products made up roughly 2/3 of those exports, or approximately $36 billion, illustrating how Ireland has become a major offshore manufacturing base for the world's biggest drug companies. But the US drug price reduction plan could hit that trade hard. Lower US prices mean lower margins and trim export revenues and possibly less investment in Irish production facilities. It could make the US market access more complicated for Ireland-based manufacturers. Multinational drug companies are already reevaluating their capital plans and transfer pricing strategies. It's an external shock that could weigh on Ireland's economy, even as EU leaders work behind the scenes to mitigate the damage through trade diplomacy. The key question for Ireland is how to adapt. Ireland's economy, while resilient, must brace for a period of uncertainty as this policy unfolds. Some companies may reconfigure supply chains, diversify export bases, or lean harder into R&D. We could even see lobbying intensifying in Brussels to secure trade carve-outs or subsidies. It's a pivotal moment for a sector that's been a pillar of Irish economic resilience. So, after all of that, where do we stand? Well, for the UK, there's progress. Lower interest rates, modest trade wins, and some renewed optimism. It's not transformative, but it's a step forward. In the EU, the path is murkier. Trade tensions remain unresolved and negotiations with the US are delicate. But equity and credit markets seem to like the direction of travel. Risk assets have rallied, issuance windows are opening. Still, don't get complacent. Not every sector will benefit equally. The shifting global trade environment is going to hit some names harder than others. Markets are hopeful, but hope is not a strategy. The coming months will test how well these agreements hold up under real-world pressure. As ever, we'll be watching credit spreads, issuance trends, and macro indicators to see where sentiment goes next. That's all for this edition of the Credit Compass. If you found this episode useful, please like, subscribe, and share it with friends and colleagues. And for more in-depth financial research and credit ratings, please visit us at kbra.com. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.